Welcome to Momentum Monday. Today is June 16th, Sunday.
When are you going to be a dad already?
I don't know when, hopefully one day.
I'm tired of being your parent.
I'm sorry?
Did you get me anything for Father's Day? It's like I'm your parent.
Yes, I got you something.
It's probably another Amazon gift certificate that I've never cashed. I probably have thousands of dollars of Amazon gifts from you that I don't even know how to get.
Yeah, you should set up a startup that, capitalizes on that, right?
What do you think? I'm kind of, it's a golf weekend for me. Played some golf. My back's feeling better. I had my member guest. I was just terrible, but I'm watching some golf today. And let's get to the market. Sunday, what is it? June 15th, maybe 16th?
June 16th. Let me share my screen real quick.
Pretty interesting. Pretty interesting markets.
I mean, I wouldn't call them interesting, but
yeah. I think it's interesting. I think this is going to resolve to the upside. I mean, a couple of weeks ago, I was ready to roll over on this, and pretty constructive. But let you give us some set the table here.
Last week was basically a consolidation week, which was to be expected after that monstrous rally at the beginning of June. It's completely normal to see consolidation. And the good news for the bulls is that that consolidation was sideways through time. So, I mean, the deep buyers were obviously dominating the tape because even that big rally, we did not see a pullback. Like, as you can see, the market just went sideways, which is typically a bullish sign. Many of the tech momentum stocks are also in consolidation mode, and after the big short squeeze we saw in many of them in the past couple of weeks, I think some of them are still looking good. Like this one is looking good, but if you AYX, but if you look at MongoDB, there it's kind of in consolidation mode. Cyber, for example, also most of them I expect that they will continue to be in a range, and this is why I titled this Momentum Monday, "Are we back to a range-bound market?"
Yeah, software seems to be buying time, Ivan, but there's a lot of stuff working. I mean, I'm gonna take over a little bit today because I got a lot on my. So Ivan, you're right. There's some consolidation here, but these stocks could get going again. The ones you're showing, CyberArk, Zscaler. The IPO this week that was hot. What's the name of the one? Which one?
Fiverr.
Nah, not Fiverr. I'm not interested in that. Those all end up the same. The software one.
Software, I don't know.
No. It was a security software one. Crowd.
Crowd, yeah. Crowd.
What's the ticker on it? Can you pull it up?
Yeah, it's right here. Let me pull up a different time frame. So here we go. This is a 30-minute.
Okay. So what interests me there is it's in cybersecurity. So the Zscaler and CyberArk that you said, this is a hot deal, and and companies growing really fast. So it could help those SaaS companies that are in security that you brought up earlier. But there's a lot of breakouts. I think one of the most interesting breakouts in stocks of the year is my favorite company, Disney. I remain super bullish. I have massive volume here, summer months, to this breakout. We're going to see this week if that follows through. But if we look at that on a weekly and a monthly, we could be in this period forgetting sales growth and forgetting the fact that it's overvalued. I wrote this week, and then Josh Brown wrote a great piece about cost of capital. Disney, and I feel the other one that I talk about a lot here, McDonald's, have made this transition, agonizing maybe for them, but they've made this transition and I call them 8 to 80 stocks, where the 8-year-olds are going to have a lifetime with these brands. There was a point where maybe McDonald's, because and Disney and Nike were at risk of losing the young generation to maybe the internet and new brands. But I think these 3 brands, which aren't tech companies, but are kind of the best technology enabled older brands, are starting to prove that their valuations could start rising because cost of capital is so low, and they've made this transition to the next generation. With Nike, it's their own stores and it's the internet, it's e-commerce, and for McDonald's, it's just automation, the computers in the store, better menus, and for Disney, it's the Netflix, the Disney Flicks. And this week I wrote about Goldman Sachs, which is trying to, Josh says, trying to be the next BlackRock, but no matter what they do in converting themselves into a new company, their margins will never be the same. They could fire 90% of their people, which they probably can't do because they have to maintain their old business of markets. But at the same time, the new internet, the millennials will create, and crypto and all these non-bank banks are standing in their way. If we look at all the banks, Citibank, basically nowhere in 4 or 5 years. Wells Fargo, Bank of America, it's been 3 years now in the 20s. JP Morgan Chase, probably the best performing of them, but there's Wells Fargo. So, and then the other interesting story I think now coming up, Ivan, on the rest of the year is Facebook.
Yeah.
It's had a rough year. I don't think, there's a company that couldn't get worse press or couldn't probably be more in the spotlight negatively for good reason. Well, I'm not a Facebook user. I like Instagram. I like WhatsApp, but I don't use Facebook at all. It's not even on my phone. But their announcement of the cryptocurrency, while getting a lot of hype, if they had announced this in 2015, 2016 on the last crypto run, it might have driven their stock higher, but nobody would have believed it. I think now that we're in 2019 and Bitcoin's back at 9,000 and Facebook's approaching this from a global aspect, and the fact that Bitcoin has such a big brand and crypto and tokens have kind of been washed out, I'm pretty excited for what they've announced with Libra. And the fact is that at worst, Facebook will give this a best effort. And at best, it's doomsday for a lot of the old banks. And I think that the market's starting to price that in on the banks. If we pull up the XLF, Ivan, you would think this would be a great environment for banks, wouldn't you, over the last 3-4 years?
I mean, low interest rate, yes, it should be, but
it would have been a fantastic environment. So something bigger is going on here and structural, finally, because I hate the banks, is they're being attacked from all angles. They can't get out of their own way fast enough. The fees that they charge are egregious. Millennials have no affinity to them because of they don't go into banks, and they're onto the fees, and they micromanage their own finances and are used to living with $100 to $200 in their account, paycheck to paycheck, and are most likely willing to try new things, be it with the way they did it with Venmo, and as Facebook launches a token, or a stable coin, or whatever we're going to call what Facebook's launching, others will be able to copy and work within that. And this is all money that's going to be floating off the system if Facebook can move trillions of dollars into their economy and it's off the bank's balance sheet, which they're basically charging you to hold, the banks could just be in for a nightmare scenario over the next 3-4 years. Now, I'll add to that, Ivan, that, I have a sneaking suspicion politically that Elizabeth Warren's going to win the Democratic nomination here next year. And she doesn't like the banks. Now, I don't know if she'd ever be president if she can beat Fatso, but she hates the banks. She's been clear about that. And that'll be an interesting thing. So let's go to the list, see what else is working here, Ivan, quickly. Just our market wisdom.
Yeah, this is the latest Momentum 50 list. We'll just show you the top quarter of it.
Yeah, I thought biotech has been interesting.
Absolutely, quite a few biotechs showing up or setting up.
The genomic ones, Ivan. There's VCYT, which I mentioned in my room, which I'm long.
VCYT, yeah. Let me open. Yeah, definitely a breakout last week and finished near the highs of its range.
Yeah, I see this other genomic stock. If you go back to your list, Ivan.
Okay.
I see one Voyager, which I had never heard of, showing up on the list.
Oh, yeah, it's a new one. Definitely very constructive setup.
Very constructive. Again, genomics. Severe central nervous system diseases. So this has been a genomic stock that's kind of hung in there. It's been wild, but I'm telling you, if there's a run here, and with rates staying low, and with everybody focused on big tech and regulation of big tech, maybe these biotechs catch a break with our government so focused on regulating tech and media. Maybe some of these biotechs that aren't part of the index. I don't think they're part of the index, a lot of these genomic stocks, Ivan.
No, I mean, the biotech ETFs are definitely not looking sexy at all, but
that's what I'm saying. What's interesting about this is it's mostly genomics, which are these smaller companies, which are kind of the most technological of them because they're software driven, and they're showing up on our list. And I don't think it's a coincidence, VCYT. So anyways, to me, those stood out. As much as little as I know about biotech, that stood out on the list. Brazil, I think Mercado Libre is one of the most interesting companies. I've been talking about it for months. I've never pulled the trigger, but it's really a fascinating company. If you go to the website, if you just go to mercadolibre.com, I think what's so interesting, if you just spend 2 minutes on the website, look how what I find fascinating, I spent a couple hours there over the last few weeks, and it's interesting to see, if you click into any country, how different e-commerce is in each country. So if you go to Venezuela, I think you just clicked on Venezuela, right?
Yeah.
You can see it's like generators. Hang on. It's like fashion, like light bulbs. And that makes sense in Venezuela, right? And then if you go to Brazil,
interesting.
Yeah, if you go to Brazil, which is more a democratic site, you see e-commerce, you see just a whole. It's just so interesting how each country is different. Now I don't know if but they are the Amazon of Latin America, and I think this stock, although it's been a tremendous performer, has a lot more ahead of it. I just don't really know much about Latin America myself. I've only been to Argentina once. So it's hard for me to have conviction other than price. But if we look at Mercado Libre over the course of, 20 years, 15 years of the IPO, it's really just finally starting to get, the breakouts in 2015, 2016, it's been an incredible run. Don't get me wrong, it's tripled since 2016. But if you're going to make a bet on the internet and Latin America, that's what. The stock that I've owned and talked about is PAGS, which is an pure e-commerce play, kind of a recent IPO, finally kind of heading up to the top of its base. For all intents and purposes, other than the original trading in March 2008, it's at an all-time high. And there is I'm done a lot of work here. I'm kind of really excited about this company. No one really talks about it. Everybody talks about its competitor STNE, which has Warren Buffett in it and Goldman and everybody else in there. And it's definitely one that I follow, but is lagged. What else, Ivan, from the Momentum 50 list?
Well, there are a few. Profit, for example, is setting up. I think it's showing relative strength, while the rest of the tech stocks, Momentum tech stocks are consolidating. This one is back near its all-time high and setting up a potential breakout. But keep in mind that if this is really a range-bound market for the next few weeks and indices will go in a range, most of the breakouts might not great follow through. Last week,
it is a stock picker's market. I'm not expecting much from the indexes.
One sector that stood out last week was retail, which was pretty beaten up. And last week, we saw some very interesting breakouts. Without counting Lulu, the two earnings reports, Lululemon and Restoration Hardware, they were kind of faded, but continue to keep an eye on them. I think the buyer stepped up here near the.
Yeah, but holding well, considering their valuations, Restoration, Lulu,
and the same with RH. Like, just because it was faded here, right at the 200-day, doesn't mean that it's over. But last week we saw very interesting breakouts like this one. Again, right at the 200-day, just if this level here, 1850 is cleared.
Yeah, I think Callaway's getting passed over once again. This golf business is too hard. Ulta Beauty is definitely one that
breaking all-time highs after a pullback to the 200-day.
Yeah,
this one
a little too volatile for me, and I don't use the stores or the products. So Ivan, good on retail. What else on the Momentum 50? And then walk people through the offering that you have at
retail. I also like, there's some very interesting biotech setups, as I said, and they're just in some individual setups like CSI.
Yeah, what does that one look like, Ivan? CSI.
It's just setting up near 40, but kind of needs to clear 41 even to get going.
What's the weekly look like there, Ivan?
Which one?
What's the weekly look like on cardiovascular?
Yes, let's take a look.
Yeah, wow. That is a long base.
It's a long base. It has 7 days of short interest. This is a very large short interest. So if
medical devices for artery disease, very interesting. So with diabetes, maybe, and with I'm adding that to my list. I think there's too many of these that are showing long bases.
Yeah, and another one that might be a potential short squeeze is.
Yeah, I've been watching this, Ivan, as well. Stitch Fix, everybody. This is kind of Netflix for clothing.
Another one, IPO, RLVL is kind of similar, I guess, similar model.
Farfetch, people in my room, Ivan, a lot of smart people in my room in the corp dev side, talking about this Farfetch. I'm trying to think of the symbol. See Farfetch.
Oh, here we go, Fetch. Huh, interesting. I mean,
nothing there yet. But maybe catch up to its valuation. Still losing money, but it's kind of like a lot of smart people are saying it's kind of like another Etsy, but on the luxury clothing side. So I'm going to keep an eye on that one as well. I'm not, I'm hearing that's more of a platform. Take a look at Etsy.
Yeah, the IPOs have recently been very hot recently. Etsy is back near all-time highs, and it's just
Etsy's digesting these huge gains. If you look back at Etsy, which I'm long for a long time, it's digesting some big gains, which I find healthy. Which brings me, Ivan, I want to answer a question from one of our users that is really important. I think Shopify, we'll pull up Shopify as the example. This is a stock that I've been long, I think, since the 20s, when some corp dev, Billy Itchev and Alex Barr, really people that I trusted back after its IPO, which obviously was, the stock has never been cheap. But in the 20s, back in 2016, I was buying it. I've been recommending it, not up here, but just as a hold. I've been, for people that have been long with me. And one question that I get a lot, Ivan, I wanted to walk through it here, because you definitely aren't the target market for this. But one question I get a lot is, how do I hold these things? How do you know when to stay with things? And so for people, I want to give people a few examples, if that's okay, Ivan.
Sure.
Because you think of things in terms of swing, right? You're not trying to have one stock change your life. Walk through how you think about owning stocks quickly, and then I'll answer this question for people.
Oh, okay, so in any given year, we probably have, let's say, 100 to 200 stocks that will double, but you will have thousands of stocks that will go up 20 or 30% in 2 to 3 weeks within that year. So I think just the odds are a lot better of finding multiple 20 to 30% or even smaller moves, and just keep rotating your capital into the best setup. And I mean, gains can accumulate pretty quickly if you just continue to do that, to actively rotate your capital into the best setups. I mean, and if it,
so that's how you used to think of things at Market Wizard. I'm not against that, because you're young and you're in wealth accumulation. You think of this as a business for yourself in wealth accumulation mode. I think of the markets completely different. So the question came to me, Ivan, and I highly recommend people follow you, obviously, as my partner in this, but I have a completely different style than you, and that's what makes the markets great. I don't believe the stock market is for getting rich, although I think can be done. It's just not me. I've learned that for me to hold things, I prefer private markets. So I've gotten lucky over the last 10 years, and this is to answer the question that I get about how do I hold things, that for me, I found it very hard to hold things once companies are public, because I can see the price every day. I think what hinders most people is the fact that you can access the price of everything and hear chatter about your companies, whether you want to or not, from 1,000 different sources, whether it's TV, newspaper, your social networks. And so it's much harder as public companies to hold public companies. But the reason I like Shopify originally was, and again, this is how I build my 8 to 80 list and my growth stock list, is first things first is I want to buy network-based platforms, which Shopify was part of. Secondly, Shopify was an enabler, a platform for helping people build businesses, much like WordPress before it, or Wix, or Intuit, for H&R, for website building. Shopify was allowing people to do that for e-commerce. Third, founder run still, it's probably a 10, 12-year-old company, still founder run as let's see what the valuation is now. 20 billion, 30 billion?
Shares outstanding.
Yeah, 33 billion. I think can easily be a 50 to $100 billion company. But obviously the risk continues to rise. This was different as a $10 billion company. Now they're too big to be acquired. So things have changed with Shopify. Now they're kind of too big to be acquired. No one's going to pay 50, 60 billion to buy this company. So Shopify has to make it on their own. It's not going to be bought on a 20% dip by Facebook anymore. They've jumped the shark in the sense that if it falls 30%, no one's going to step up and say, "Oh, Shopify's cheap, we need to own it." But you can see how many periods, even though it's risen, 1,000%, where months, even a year at a time, where the stock does nothing. And so to hold these companies, you have to be able to tune out the noise and understand that a couple things. Look for companies that fit a specific niche of the era. And right now that's software networks, platforms, high margin, as they're under, from under $10 billion, they could be acquired by the planets. So they will be bought on dips. But most importantly, for riding these companies, it takes the understanding that earning 10 to 15% return on capital off any investment a year is fantastic. So if you find a great business, don't be so quick to sell it, because timing these businesses and trying to find other companies that can return 10 or 15% on your equity every year are very hard. You sell your Shopify, or you sell MasterCard or Visa or other companies in my list, and it's very hard to find other companies that fit all these descriptions and can return on average 10 to 15% on your equity over 10, 15 years. And we can see on MasterCard, that's what made it easier for me to ride these companies, is knowing that if I sell them, I also now have to go replace them with other brands that can do the same thing. And I'm not saying that's impossible, but what I'm saying is I understand by owning these that as they rise and get more valuable, that the returns or the return on capital is going to shrink because of law of large numbers. But at the same time, to replace it just to replace it and pay the taxes is very hard to do. And I try and teach young people when they're looking at flipping out of great companies, that's what they have to try and do. To make 10 or 15% on the market is very hard, even owning an index.
But
and
to take into account that the last few years have been very favorable to long-term holders because the dips have been very shallow.
And a lot of that could be what I wrote about this week about the cost of capital. Just maybe it will stay low forever.
There is no alternative basically for stocks, but
just to sell them because you're trying to figure out, that interest rates are going to rise or that there's going to be a recession is silly, because the risk of being wrong, especially going out and paying taxes on all these things all the time, is silly, because you got to go replace it with another asset that you think can do the same thing. So investing for the long term, what I'm saying is not for everyone. But you can't just say, I want to hold stocks forever. You may not be wired to do that. The stock market, I still believe, is best served by people to find great companies and let your money sit. But if you can't, it's okay if you're not wired to be able to do that. You can't just beat yourself up and say, I don't know why I can't hold stocks. But to hold stocks, I'm trying to tell people that they've got to understand the dynamics of investing and staying within their, understanding how markets work, and that 10 to 15% a year returns by any great company is very hard to replace. And that's why I built the 8 to 80 list, which tries to find companies that fit this description. And there's not hundreds of them, but there's definitely 20 to 50 of these companies that I think fit this model. And I'm not saying that you can go buy Amazon today and earn the returns that you've done, because we're looking at Amazon right now, over the last 10 to 12 years, because I think I added it in 2009 and 2010 and have just held it. And I'm holding my nose up here because I know valuation, I know the government, I know Bezos has got issues, but at the same time, Bezos is still there. His wealth is tied up in this company. And to go find another Amazon and just selling it because it's up 100%, and pay the taxes on it and have to go replace it with another company that could get you the returns that Amazon does is a very hard thing to do. So what I try and do, Ivan, and this is what I tell people in Market Wisdom and in my room, is that you're constantly pruning your portfolio until you find these Amazons and these Shopifys and this Twilio. I'll take another example of Twilio. Founder run, perfect, a company for the era. It's a platform. It enables people to do marketing by voice and by phone and by text. So it's an enabler to millions of other companies. Again, founder run, incredible growth, and still a small company, at $20 billion, just starting to hit the sweet zone. Can it get bought? No. So is there more risk than when it was, a $3 or $4 billion company? Absolutely. But the reason I'm not selling it, it's going to be very hard for me to find a business that I think over the next 5 to 10 years, as long as Jeff and the team stays at that company, and as long as the technology and the platforms that exist today continue, these are companies that I want to continue to add into my portfolio. And I prune companies. So I'll give you an example of STNE and PAGS. These are two companies. I own them both. Talked about them both at length. And, the jury's still out on these, but I want to have exposure to Brazil. I want to have exposure to e-commerce in Brazil. And of course, Amazon could be that company and Facebook could be that company. But I want to own new economy Brazil. And so I've narrowed it down to 3 stocks because I don't want to own the ETF and own all the companies that have high cost of capital mixed in with my low cost of capital. So EWZ means nothing to me, Ivan. I don't want to trade an index when I can own the future. And so I'm looking for companies in this part of the world which are mirroring or mimicking the greatest companies in North America and China. And I don't know if it's going to be Stone or Melly or PAGS or Amazon, but by nature of following these companies and seeing how they ride together, I can see that PAGS right now is executing. You can see the earnings growth at 39 to 50%. We can see that it's it's in that sweet spot of $10 to $20 billion when they start to get recognized. Founder run, payment technologies in the hot area of Latin America, which is Brazil, which is the most democratic of the countries, and has the domain experience within Brazil. So yes, you can play this trend by owning Amazon and Twilio, but sometimes you have to dive deeper. And this could be a stock that I'll slowly learn more and more about, but I'm trying to build a position in companies. And by doing this, Stone got pruned and PAGS I'm accumulating. And it's still very early, and you have to keep an eye on all of these, but that's how you build positions and find companies that you can hold for a long period of time. But they have to fit in with these categories. So hopefully that helps. I'll probably write a few blog posts about this. For me, Ivan, what was most helpful was investing in private companies because I'm forced to hold these companies and not look at their prices every day.
Yeah, exactly. So, also, you need to talk about your position sizing, because if you have a small position size, let's say 3%, 4% of your portfolio in any of these, even if they go down 50%, like the damage is
good
not
point. Good. So another way, good point, Ivan. So with holding Shopify, it's never crossed more than 5% of my portfolio, and I've always sold it down because, again, I'm not running the company, and I've always sold it down to keep it at 2 to 3%. I wish I hadn't, and that's how professional money managers try to manage money. They understand that it could become 10 to 15% of their portfolio, but because I manage my own money, I'm not looking to become super wealthy off the stock market, and I understand my own risk profile, that I prune to allow the fact that I know Shopify could fall 40%, and that within the realm of the history of this stock, that's quite possible at any moment. And so I want to own my position size that allows me, to ride that out. And the reason you're diversified, right now I have almost 20 stocks in my portfolio, which is at the high end for me. Because probably this, there's so many good setups and there's so many stocks that I've ridden and had to stay in. But at the same time, you have to prune. And that helps me stay in positions.
Okay, so that's a pretty good overview. I'm sure that you'll follow up with some blog posts. And
yep.
I think it's a very interesting topic for many people, because most people cannot afford or don't want to actively trade. So
Well, I think they just can't visualize how companies can increase 1,000% or 2,000% over 10 or 15 years. And they get so excited to make 10 or 20%. And there's nothing wrong with that if that's the business that you're in and trying to invest in stocks. But I think the real wealth comes from understanding how markets work themselves and being realistic within the framework of earning 10 to 15% a year on an asset, which can be done over 10, 15 years, but it's hard to do much better than that. And so constantly turning over your portfolio, chasing new ideas is a really hard business. And when I find great companies, I'm willing to let them go sideways for 2 or 3 years as long as they have certain characteristics: founder run, network based, platform enabled, incredible brands. And then you do have to follow them. And then you have to, like you said, Ivan, manage the risk within your portfolio. So hopefully that helps. Everybody have a great week. And any big earnings this week, Ivan? Any big events that people need to?
I mean, I haven't checked, but the earnings season
I think so.
is almost over. So the next one, I need to wait a month until the next one. So
yeah, it's kind of a perfect environment for stock picking right now because there's, even with market events, it's kind of a quiet summer, so stocks can be doing their own things. And we'll see you all next week.
yes.